You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I think is a big mistake for the major mining companies to be boosting their dividends the way they've been doing in the last few months. You know, mining is a capital-intensive industry. We know that. That means mining companies are always going to want capital. So to me, when you have good, strong cash flow, you don't want to be giving that away to shareholders. Admittedly, people who own the company, I understand that, but you don't want to be giving away dividends and then having to turn around and raise money in the market because you need an expansion or you want to buy something.
Welcome back to Mining Stock Education. I am your host, Bill Powers, and I'm reporting from PDAC 2020, and I'm speaking with one of my favorite people in the resource sector, veteran resource investor and fund manager, Adrian Day of Adrian Day Asset Management. Adrian, it's always great to see you. Thank you for sitting down with me again. And after the recent panic in the general equities and the sell-off even in gold and the gold stocks, I'm wondering, as a fund manager, a money manager, what type of calls were you receiving and how do you handle that?
Yeah, well, thank you for having me, Bill. It's always a pleasure. You're one of my favorite interviewers. Typically, I have to say, we don't get an awful lot of calls from clients on short-term moves in markets. And, I try to emphasize to my clients, when you hire a money manager, that's different from hiring a broker. You're hiring a money manager to make decisions for you. And the last thing you want to be doing is panicking, or conversely, when the market's up, be saying, why aren't we fully invested and so on. And generally, we don't get a lot of calls from clients, frankly, on short-term moves in the market. Now, there's obviously a lot of concern about the coronavirus, and is it going to spread? Is it going to get worse? And the truth is, I don't know. I'm not I have no medical training at all. So, I can't be much help there. But you have to you weigh risk with reward. You look at the value in companies. You look at companies that are going to still be around. You reduce companies that are dependent upon global trade, shipping companies, and so on. You do some of the obvious things, but I think the truth is nobody really knows what it's going to look like 3 months from now.
And if we continue to see a sell-off, we would expect the base metals to get hurt. You're extremely bullish on the base metals long term, but could we see a longer base metal bear market than we think?
No, absolutely. And I don't want to give the wrong impression. We are not buying much in the base metal. We haven't been buying much in the base metals base metal arena since the last time we talked. Most of our buying has been has been in gold and silver. We've done very little in platinum and palladium, frankly, so we've missed something there. But we've bought very little in the base metals. I think, again, looking at the risk-reward, it definitely favors the precious metals over the base metals. You had the trade, and that was 6 months ago, looking at the trade dispute between China and the U.S., the slowdown in global trade, the slowdown in the economy, Germany teetering on the edge of a recession for the last 6 months. The whole macro environment globally was not really positive for the base metals, so we weren't buying much.
You are a big evangelist for why you would want to invest in a gold royalty company. When you're looking at the gold royalty companies, they've kind of led the way in this bull market where some of these junior miners don't even have a pulse right now. At what point do they become overvalued?
That's a good question. There's no question that the big royalty companies right now are far from, what I like to say, Graham and Dodd value investments. But I think we have to realize, if you look at a company like Franco-Nevada, for example, the largest of them, it's overvalued on an earnings basis, a cash flow basis, but it's been overvalued on an earnings and cash flow and book value basis ever since it was spun off from Newmont. What was that, 10 years ago? So there's a reason these companies are apparently or on the surface overvalued, and the reason is, A, they have very low risk business models, And B, there is a lot of upside in these companies that's built into the cake. You look at a company like Franco, with the Cobre Panama that came on stream, at the end of last year. You've probably got 30% increase in earnings over the next 3 years that's baked into the cake. And so these companies deserve higher multiples. I think we're a long way from these being sells. Now, a lot of people think, well, the royalties are okay in bear markets, but in a bull market, you want to be in the operators. And I'm not suggesting that the big companies like Franco or Royal or Wheaton are going to be your best performers in a bull market. I'm not saying that. But what I am saying is these companies have plenty of leverage to higher gold prices. And they have leverage, first of all, of course, if the price of gold goes up, price of gold, silver, and other commodities goes up, their revenue goes up. That's the first thing, obviously. But the leverage comes from companies on which they own, companies on whose ground they own royalties or streams, doing brownfields exploration and expanding the mines and building up the production. And so all of that extra production on which these companies have royalties or streams comes to the royalty company without any additional investment. So that's tremendous leverage. That you have companies on which they might own a royalty. It might be a small company. They might have a royalty for the last 10 or 15 years. A higher gold price, and suddenly this company starts, building a mine and coming into production, and the royalty company gets revenue for no additional capital. That is tremendous leverage.
We'll be right back after this word from our sponsor. Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to OsinoResources.com. That's OsinoResources.com. Adrian, I know you don't focus on small single asset producers, but a question I've been asking myself as I've been looking at small single asset producers is, let's say there is a small single asset producer, they've been producing for a year, they have free cash flow of $20 million, no debt. What multiple should they be trading at?
I think a large part of the answer to that question depends on whether they are a potential candidate for being taken over. If it's a single asset mine that is just doing its thing and putting the money back into the ground to, expand the mine to make the mine last longer, to extend the mine life, that doesn't deserve as big a multiple as a company that might be a takeover, or the company that's using that cash flow to go out and buy other assets and build a mine. I don't know. I mean, a lot of these companies should be trading at 1.5 to 2 times book and 10 times cash flow.
10 times cash flow. I was thinking 6, but 10 sounds better.
Again, a lot depends. Again, if you've got a single asset and there's really no upside, no one's ever going to take it over, there's really no upside to the mine, it's obviously a lower multiple than someone that can expand the mine or buy other deposits around the mine site.
When you look at the mid-tiers, are there any mid-tiers that catch your eye, or what commentary could you provide with your observation of the mid-tiers right now?
Oh, yeah, there's a lot of them. I mean, first of all, B2, for example, has done an incredible job. Clive Johnson is a dynamo, and he's done a really first-class job building that company. Now, they are in some, how should we say, problematic jurisdictions, but I think the price of a stock discounts that. On a cash flow basis, that's trading at a large discount to other companies of a similar size. So there's companies like that, and there's quite a few of those. Well, not quite a few. There's several of them. Obviously, Equinox, which is Ross Beattie's company. I mean, who am I to argue with Ross Beattie? But, I'm not a big fan of the assets. I don't think either of those two assets looks to me to be what I would call a world-class great deposit. But you've got Ross Beattie backing you, and, it's always worth betting on Ross Beattie. So he's going to build that company. I think he's going to do what he says he is, have a 1 million ounce producer within whatever he said, 5 years, and then somebody probably wants to take it over. Who knows?
In the major miners, they're giving away dividends. Are they giving it away the dividends too early rather than reinvesting the cash?
That's a good question. I think is a big mistake for the major mining companies to be boosting their dividends the way they've been doing in the last few months. Mining is a capital-intensive industry. We know that. That means mining companies are always going to want capital. So to me, when you have good, strong cash flow, you don't want to be giving that away to shareholders. Admittedly, people who own the company, I understand that, but you don't want to be giving away dividends and then having to turn around and raise money in the market because you need an expansion or you want to buy something. Look, the truth of the matter is, and we've seen this yo-yo with dividends, which I think is another sort of mistake. If you're going to introduce a dividend, have a consistent dividend, something you can sustain. It might be a level that's sustainable, or it might be a linked to the gold price that's sustainable, but something that's sustainable. And we saw in 2009, 10, 11, 12, all these companies boosting their dividends. Newmont, remember, linked their dividend to the gold price. All these companies boosting dividends. And then, 2013, 14, 15, all these companies cutting dividends. And now they're raising them again. I think it's a mistake. Look, nobody buys Newmont because it pays a dividend. Nobody buys Yamana because it pays a dividend. I think, I think you pay the minimal dividend just so that, pension funds and people that have to have a dividend can invest in you. And other than that, and after all, most of the gold mining companies were yielding, 1%, 1.25%, nothing to write home about, right? But what's the dividend on the S&P? The dividend on the S&P is about 1.6 right now. So it's not like, you're competitive with the rest of the market. I think the only gold mining companies that should pay a dividend are royalty companies where you have sustainable cash flow and your need for capital on an ongoing basis is less. So the
majors shouldn't even pay dividend?
I think they should pay the minimal dividend out. If they pay 0.5%, 0.75%, just so that they can be invested by institutions whose charter says they can only invest in companies that pay dividends. There's a lot of those, as you probably know. But other than that, I don't see the point, because they need the capital.
I remember at last PDAC, you and I talked about the Vale dam collapse.
Oh, yeah.
But it's been articulated to me that perhaps a lot of the stress on ESG issues could be emphasized a little too much. What are your thoughts here?
Look, I think a mining company needs to be a good citizen, just as we all need to. We all need to act morally in whatever we're doing, morally and ethically in whatever we're doing. But I do think that it's become a little bit of a fad, frankly, and often putting the cart before the horse. I mean, a mining company has to, build a mine and make money before. I mean, that comes before worrying about, social, environmental, and governance, in my view. But again, I think people should act morally. But I see it in my business. I'm not going to cheat a client. And that's what's important. I'm not cheating clients. I'm not stealing their money. I'm not front-running them. I'm not lying to them, all of that. But the hundreds and hundreds of pages of rules that we have to follow are frankly meaningless. They're not helping on the ethics of the business. They're just, bogging us down in bureaucracy. And I think there's a lot of that mining companies. I've nothing against women on boards. But when a company says, oh, well, we had to tell him to step down because we have to put a woman on the board, are you really improving anything? I don't think you are.
As we kind of wrap it up, what are your thoughts with the conference? We're speaking at the end of day 2. It seemed like attendance was way down on day 1 to me. What are your observations?
Yeah, attendance is definitely down. Now, I don't know what the number is. Attendance is definitely down significantly. But it's not a desert down there. I mean, there's a lot of people walking around. It's also a lot of companies have canceled. That's another interesting thing. But as you say, it's the end of day 2, and I was up for a 7 o'clock breakfast. You know, I'm already worn out, and it's only day 2. But I think people, I mean, obviously, the mood, I mean, a lot of people are really wanting to know, well, what's going to happen with this coronavirus? You know, we don't know. And the answer to that question really determines whether you should be buying now or whether you should be selling. I mean, we're buying. I think some of the prices are you know, some of the companies are selling at ridiculous valuations right now. And there's a lot of really good buys among seniors, the juniors, you know, exploration companies, everything.
Excellent. You've been listening to Adrian Day of AdrianDayAssetManagement.com. As always, Adrian, thank you for joining me on the show today.
Well, thank you very much.